is Scott Becker with the Becker Private Equity Podcast and the Becker Business Minute Podcast. We're thrilled today to visit with Rick Kess. Rick is a partner at RSM. RSM is sort of the preeminent firm in sort of mid-market private equity and growing upper market as well. A lot of sell-side diligence, a lot of quality of earnings, a lot of work for private equity funds investing in sponsored companies and platform companies and so forth. A brilliant firm. Rick's going to talk to us today. We'll have two separate podcasts with Rick today. This one will be on key trends that he's watching in the private equity market. We'll secondly have a podcast with Rick on leadership, thoughts on leadership in a challenging economy and generally. Rick, can you take a moment and introduce yourself?
Sure. Thanks, Scott. Yeah, my name's Rick Kess. I'm a partner at RSM, as Scott mentioned. We focus on a lot of private equity groups and their portfolio companies, and glad to be on the podcast today with you, Scott.
Thank you, Rick. And tell us, we're sort of the market at the start of 2023 is topsy-turvy. Everybody talks about there being a slowdown in private equity sponsored deals towards the end of last year, the start of this year. Some you hear a lot of expectations for a real pickup second and third quarter. What are you seeing at RSM? What's some of your sense of what's going on in the private equity deal market currently? What are some of the things you're following?
Yeah, Scott, I think we're seeing similar trends to what you're talking about. A little slower market this month than we would have preferred. But I think I'm hearing similar feedback from both private equity groups, banks, other interested parties that, hopefully the last half of 2023 really kind of overcomes some of the slowdown we're seeing right now. And I think there's just continued uncertainty relating to, just an economic slowdown. Labor is still, surprisingly still an issue. But then we're also seeing, some of the large tech companies laying people off. So, I'll be interested to see kind of how those macroeconomic impacts really kind of come full circle and perhaps, change the deal environment and deal flow activity for us in the next, 6 to 12 months.
Thank you. And is there a sense of the interest rate environment and how much that's having an impact? Any sense there?
Yeah, I think the interest rate environment is definitely having an impact. And I would say, it may be not even the rate that is somewhat of an impact. It's maybe the willingness and ability of banks to lend, on terms that companies are willing to accept. And I think we talked about this in the previous podcast, but, good quality companies, good credit risk companies could still obtain credit and obtain debt. I think the riskier you get, the traditional banks are starting to become a little bit more hesitant. And I think you're looking at other bank alternatives and, that just becomes very costly in a deal. So I think just running those numbers and running that projections out, sometimes that's just really causing a bit of a slowdown for what we're, typically seeing in the middle market, in particular in the lower middle market. I think is probably the most challenging area.
And what are you seeing? Are there different industries where there's more aversion or less aversion? Are you seeing some of those discussions?
Yeah, Scott, I think, my background is a bit more focused on healthcare than other industries, but, and I think healthcare, traditionally has, a little bit of a belief that there's some, insulation from economic impacts. There obviously always is demand in healthcare, whether people can actually pay for their services, especially those services that tend to have, high deductible plans or anything where the consumer is responsible for a big part of their services. I think those, so I think healthcare is perhaps still a little bit insulated from that, but I think even in healthcare, we're seeing a slowdown. So I would say that's the only industry that I'm seeing, a bit of a difference from what we're hearing with other industry groups at RSM.
No, thank you. And even in healthcare, you are seeing the softening of margins or the challenging in margins in not just huge health systems that are seeming to recover a little bit right now, but just regular practices that are often bolt-on acquisitions for platforms. They're seeing their margins get a little tougher, aren't they?
Oh, margin's an extremely challenging environment right now. I mean, a lot of healthcare is pretty fixed on the reimbursement. There's not a lot of levers to pull sometimes in, fee for service environment. So I think, with that in the challenging labor environment, in the high, the cost of goods, from an inflation perspective, I think health care systems, private equity group sponsored companies, every piece of the sector is challenged by margin. So it is an extremely important thing to, kind of monitor and watch, because, I don't know, outside of, moving closer to a value-based care system, I don't know what providers are going to be able to do to kind of change that trajectory if costs of labor and goods don't, sort of slow down or turn around the other way, and perhaps even go down to some degree.
Thank you very much. Anything else you have your eye on as we head into this sort of end of the first quarter, second quarter of 2023? Anything else did you have your eye on?
No, I mean, I think it's common themes. It's interest rate, it's jobs, and it's inflation. So, I mean, they're all three kind of tied together and kind of have, an interesting relationship between all three areas. But those are the three things that we continue to kind of watch and model and try to think through what impacts will happen to affect our clients.
Thank you very much, Rick. As always, thank you for joining us on the Becker Private Equity Podcast, the Becker Business Minute Podcast. Always interested to sort of hear the insights and see whether sort of what's going on confirms or resonates with our audience and what they're seeing in the private equity market. Thank you, Rick Kess, for joining us. Thank you.
Thank you, Scott.